When we invest, we normally think about the central case, the most likely outcomes in the future. However, when we're thinking about risk, it's sometimes useful to think about tail risks. These are low probability but high impact events which can reduce the value of your portfolio significantly. So in this video, we're going to look at the tail risks for 2023 in order to mentally prepare ourselves for them. Now, don't forget, if you do enjoy our content, please do subscribe to our channel. That way you won't miss any new content. So let's look at the stock market risks in 2023 in a bit more detail. Now, we'll be focusing on tail risks, and the way to think of these is low probability events. In other words, we're kind of low down on the probability axis, but we have a very large impact. An impact here is effectively how much your stocks will lose if one of these events occurs. So for example, this would be a pandemic, or perhaps the default of a very large company like Enron or Lehman Brothers. Now, it's always interesting to see what institutional investors like pension funds or hedge funds think are the biggest risks right now. And in this survey from Bloomberg, you can see that two risks really stand out. The first one is stubbornly high inflation, and the second one is a strong recession. The other risks would be things like escalation of the Ukraine conflict or geopolitical tensions with China. And then much lower on the risk scale would be a liquidity crunch or a crypto collapse. The US Federal Reserve, the central bank, produces a financial stability report, as do most other central banks, and it does a similar survey to the one we just saw in Bloomberg. And you can see that the primary risk is that the Fed itself screws up. In other words, it makes a mistake with its monetary policy tightening. Maybe it keeps rates too high for too long and crushes the recovery, or maybe it doesn't raise rates enough and allows inflation to run too hot. But certainly the biggest risk at the moment by many investors is that inflation persists for a long period of time. Russia's invasion of Ukraine also figures high in this survey, as do market liquidity strains and volatility. So for example, in the UK, we had a massive sell-off in the UK bond market for government bonds. And that was a result of the mini budget. And for a certain period of time, it was actually very difficult for pension funds to sell their government bonds. So that's an example of illiquidity. And when the government bond market becomes illiquid, that's a huge risk to the financial plumbing. Higher energy prices also are seen as a big risk. So far in 2022, towards the end of the year, they have fallen, but there could be a resurgence. A potential conflict between China and Taiwan also figures highly. And under-regulated non-banks, and here we're thinking about the shadow banking system, which carries out the functions of the banking system without regulation, that could potentially cause a crisis. The Fed also shows how the surveys changed over time. So if we compare the risks in May and November, persistent inflation and monetary tightening is about the same. Russia's invasion of Ukraine also is similar, but the liquidity strains and volatility certainly surged from not cited at all to being a concern for over half of the respondents. Energy prices also became more of a worry, as did the possibility of a conflict between China and Taiwan. Let's start off with the risk that most institutional investors are worried about, which is that inflation stays high. Now, what the Federal Reserve and other central banks want to avoid is that we get a secondary spike in inflation. This is exactly what happened in the mid-70s and early 80s in the United States. Now, Jerome Powell often quotes Volcker, and he's very keen not to repeat the mistakes of the past. So what's pretty clear is that the Federal Reserve is going to keep interest rates at their restrictive rate, which is now perceived to be over 5%, for a long period of time. So don't expect a pivot from the Fed, because it's very unlikely to happen. And it's to avoid this kind of scenario that they're going to keep policy so restrictive for so long. So at least this kind of tail risk, I think, will be avoided next year. Now, the rate setting committee at the Federal Reserve, the FOMC, produces its dot plots or forecasts of its committee members as to what will happen with inflation. And even the highest forecast for 2023 is 4.1%. In other words, a significant fall from where we are at the end of 2022. And then by the end of 2024, we're getting very close to the Federal Reserve's target rate of 2%. So the central case from the Federal Reserve is, of course, that they're going to fix the inflation problem. But of course, they would say that because that's their job. So this is why this is a tail risk, because the central case is that inflation is going to come down, and the tail risk is that it doesn't. Unsurprisingly, the Bank of England says pretty much the same thing. This is their forecast for inflation as of their November monetary policy report. It's called a fan chart, and the most likely outcome is the central orange band here. So they think inflation will peak at the end of this year, and then over the course of 2023, it'll come down sharply. And by 2024, they think it's going to be at their 2% target. So again, the tail risk would be that that doesn't happen. And if that were the case, that would be a huge negative for the equity market. Because remember why equity sold off in the first place. Inflation was very high, monetary policy got very restrictive, and things like growth stocks sold off hugely. So what could it be that kept inflation at a very high rate? Well, I think Jerome Powell's characterization of inflation, where he splits it into 3 buckets, is very useful. And he mentioned this in the December monetary policy meeting. The first bucket is in goods. So this would be things like the price of used cars. Now that's spiked due to bottlenecks in the supply of computer chips. But that bottleneck has now largely resolved itself, and we've seen the price of second-hand cars and trucks in the US fall very sharply, certainly on a month-on-month basis. So goods inflation certainly seems to have abated a lot. Housing services is dominated by rent, and the price of rental agreements certainly picked up as house prices increased and as interest rates increased. But what the Federal Reserve's expecting from the middle of next year is that that'll go into reverse. So this component also will probably abate. And that's because monetary policy strongly affects house prices and rental costs. So this is a place where monetary policy is very effective. And it's clearly having an effect right now. The third bucket is what has the Fed worried. Think of this as the sticky bucket. This is a bit of a mouthful. It's called non-housing related core services. So this makes up over half of the inflation basket, 55% of it. And it's all of those services which American citizens use. For example, hairdressers. If you use a taxi, it'll be a taxi service. If you use a lawyer, it'll be the lawyer's services. And all of these are driven very much by labor costs. Now, if you look at the cost of labor in the United States and wage growth, that hasn't responded to monetary policy tightening. So here's US wage growth since 2004, and that's the blue line here. And before the pandemic, it averaged something like 2.5% per year. After the pandemic, we got a spike upwards due to compositional effects, then a spike downwards. But the average rate of wage growth has been about 5.1%. In other words, double what we saw pre-pandemic. Now that's not consistent with the Fed's 2% target, and there are no signs that that's falling, at least not yet at the end of 2022. So that's why this bucket certainly seems to be stickier, and it's got the Fed worried. This could be the reason why inflation remains stubbornly high. It may require a more aggressive monetary policy stance. Yes, that means higher rates, and that's not a good look for the US equity market. Every time there's a sign that inflation's higher than expected or that interest rates will stay higher than expected, equity sells off in the US. Another worry is that energy prices surge. Remember that this was why inflation spiked in the first place. Now, if we look at the inflation-adjusted price of oil going back to 1960, you can see that most of the events which made it spike were to do with wars in the Middle East. So there was the 1973 Yom Kippur War, the 79 Iranian Revolution, the Gulf War in 1990, and so on. Then most recently in 2022, Russia invaded Ukraine. Now, monetary policy can't affect the price of oil. This is a factor which is called exogenous. It's not something that the Fed can control within its own wheelhouse. So if there was another spike in the price of energy, that would create a surge in inflation, which the Fed could do nothing about. And that's certainly a tail risk. Now in Europe, a big reason for the big sell-off in equity markets has been due to the energy crisis, due to supply problems, and that's because of the dependency on Russia. However, what's been quite reassuring is that the imports of liquefied natural gas have surged. So that's certainly reduced some of the impact of the supply shock. What's also reassuring is that Europeans have managed to cut back on energy usage. So for example, if you look at last year's demand for natural gas, that's the blue line here, this year's demand is significantly lower. And that's because Europe's been aggressively cutting back on its energy usage. So that's certainly reassuring, but notice also in this tweet that LNG supplies are going to be tight until 2026. So it's very likely that we're going to have a secondary spike next year when we get cold temperatures again. Because remember that Europe is in competition with Asia when it comes to LNG. So certainly towards the end of next year, we could see a resurgence of the energy crisis in Europe and another sell-off in its equity market. Now, if the economy weakens as many people expect, then that could trigger more bankruptcies. But because of the structure of the credit market, that could trigger a downgrade cascade. So for example, if you look at one of the largest rating agencies, this is Moody's Investors Service, their central case for next year is that the default rate will increase to 4.9%. In their severe pessimistic case, that could rise as high as 12.6%. But if you look at the default rate currently, it's below the long-term average of 4.1%. So what's really worrying right now is the silence in the global corporate bond market. And that low default rate is also reflected in the compensation you're paid for taking credit risk. So that compensation is called the credit spread, and it's the percentage extra income you receive for buying a junk bond in either Europe, so that's the EU high yield spread here, currently that's 5.1%, and for the US you'd receive even less, 4.7%. Now if there's a recession in the United States, those are the blue rectangles here, you'd expect that spread to increase to around 7%. So this is a market which is in denial. It's effectively saying there's not going to be a recession, there's not going to be a pickup in default rates, and everything is absolutely fine. So personally, I'd probably keep away from the junk bond market in the US right now because I don't think it's compensating you sufficiently for the risks which are about to materialize. Now, I mentioned the downgrade cascade. What do I mean by that? If we look at an investment grade fund, such as this iShares iBox fund, and we break it down according to the credit exposure, so AAA is the highest credit rating and BBB is the lowest investment grade rating, one notch below that is BB, and that would be speculative grade or junk bonds. Notice how it's skewed hugely towards that lowest credit quality, such that 47% of the bonds which are held by the fund are of that low credit quality. Now, if one of these bonds gets downgraded, then this fund would have to sell it because it's not allowed to hold junk bonds. And that's the kind of thing that would trigger the cascade. And the process would look something like this. Once a downgrade occurs, when a bond goes from investment grade to junk bond or high yield, then the credit spread of that bond would increase. That's because the price of the bond would fall and its yield would increase. The price would fall because of all the forced selling by investment grade funds. But that itself has an impact on the companies which have raised money in the corporate bond market. Because their yields increased, it means that it costs them more to service their debt when it comes time to roll that debt over. So when they replace their debt with new bonds, they'll have to pay more in terms of debt servicing. In turn, that means that their probability of default will increase. So that'll probably lead to more downgrades in the investment grade market. And then we get this kind of downward cycle where there are ever more downgrades, yields widen, and prices fall. And the fact that there are so many bonds at that BBB point means that there are lots of bonds which are at risk of being downgraded to junk. So I certainly think this is a risk for 2023 and beyond. Now, more bankruptcies isn't bad for just the credit market, it's also bad for the equity market. When there's a credit sell-off, as we saw during 2008 and 2009, that negatively impacts the equity market as well. Now, before we go on to the other tail risks, let me just quickly mention our membership, where you get access to lots of goodies, such as our members-only videos, but also the chat application Slack, so you can ask a question whenever you like. And you get access to these wonderful trackers, which I maintain. So for example, if you wanted to find out the latest credit spreads, you'd go to the Market Monitor here in the bottom right. And that lets you check out the latest credit spreads. And you can zoom in to see that the latest spreads are 5% for the EU and 4.7% for the US. Or if you want the latest update to the US recession model, you can get that as well. So if you want to find out more about our membership, just go to the link beside me or in the description beneath me. The shadow banking system also poses a threat to equity. That's because it has systemic importance, but it's not regulated. What is a shadow bank? Well, it's an institution which performs the functions of a bank but isn't regulated like a bank. So, for example, stablecoins are very much like a money market fund, but they're not regulated as such. So both stablecoins and money market funds would be part of the shadow banking system. Now, what's risky about these two is that there's a contagion link between them. So let's say that there was a run on stablecoin. Well, that would make the price of the assets in stablecoin fall. That's because as people pulled out their money, the stablecoin manager would have to sell those assets to redeem the funds of those investors. So the assets they'd hold in common would be things like commercial paper, those are short-dated corporate bonds, T-bills, which are short-dated government bonds, but also certificates of deposit and reverse repo transactions. All of those would fall if there were very rapid redemptions in stablecoins. Consequently, the value of the money market funds would fall below $1. In other words, they break the buck. And that could lead to secondary redemptions from those money market funds, which are absolutely huge. They're worth about $5 trillion in the United States. So all of these have runnable assets, so there could be a run on stablecoin and a run on money market funds. So this is certainly a systemic risk that would negatively impact sentiment and negatively impact the equity market. Now, many people are talking about weak growth in the United States and in Europe, but what's even more toxic for equity is stagflation. This is when we combine weak growth with very high inflation. So we saw this model when we were looking at the trackers, and the inputs to that model are based on inflation, the unemployment rate, credit spreads, but also the inversion of the yield curve. And currently that's flashing a very high probability of 88%. The model's not infallible. You can see that there is a false positive here, but it is pretty good. So where are we right now in the United States relative to a stagflationary environment? Well, if we plot growth in the United States, that's on the x-axis here, with high growth on the right and recession on the left, and we plot inflation on the y-axis, with high inflation at the top and deflation at the bottom, the red dot shows where we are right now. So inflation is well below where it was in the late 70s and early 80s, but growth is certainly weak. It's below 2.5%. And recently we've moved down from these two dots to where we are right now. But we're still far away from the Goldilocks zone where inflation is low and growth is pretty good. But what's important is that we're moving away from the stagflationary zone of low growth and very high inflation. And that's because US inflation has pretty clearly turned a corner and started falling. If we compare that with the UK, so this is the same plot for UK data, which only goes back as far as 1988, so it doesn't include the very high inflation period in the 70s, you can see that the UK is far from the stagflationary zone. Inflation is still very high as of Q3 of 2022. You can see that's where we are right now, and growth is very weak. The UK is simply very far from the Goldilocks zone. And furthermore, it's way at the top of the stagflationary zone. So I'd say for Europe and the UK, there's a much higher risk of stagflation, and that in turn is toxic for its equity market. The thing to remember though is that depresses prices and actually creates buying opportunities. And that's true of all of these tail risks, which is that they do create opportunity. The sell-offs that we see in the equity market are usually much worse if we have an earnings recession. In other words, profits disappoint. And if we look at quarterly profits for the S&P 500 going back to 2013, here they are quarter by quarter, the forecasts are shown for the next 6 quarters here in red. Notice how after the huge resurgence after the pandemic, what we're expecting now is essentially a period of flat earnings. In other words, no growth at all for a period of about a year. Now, broker forecasts are always optimistic. It takes a crisis to be staring at analysts in the face before they downgrade their forecasts. Well, that's been happening since April of this year. If we look at the full year forecast for 2023, that's the upper line, and 2022, that's the lower line. Both of them have started to be downgraded. 2023 is downgraded now by 8% compared to that April high, and 2022 by 4%. Now, some investment banks are thinking this is going to get much worse. So they're saying that there could be an earnings recession of up to 20%. If that's true, that would mean that equities could quite easily sell off by that amount. That's even after we've had a 20% to 30% sell-off in the US already. So this is why you'll hear me talking about earnings a lot over the course of 2023. Also, some of the greatest tail risks, also the most unpredictable ones, are geopolitical. So a lot of the problems that we see in Europe right now are due to Russia's invasion of Ukraine and its impact on energy prices and supplies. According to this FT article, Vladimir Putin is actually preparing Russia's population for a long-lasting war. So it could well be that this escalates further and we get a secondary spike in energy prices. However, it is reassuring that many European countries are finding alternative sources of energy. And I think a much bigger risk is that China invades Taiwan. That's because China is simply much more important than Russia when it comes to global markets and the global economy. If there was some kind of conflict between China and America, for example, that would be cataclysmic for equity markets. But I think that this is quite a low probability outcome, but still something that we should really worry about. So I hope I didn't scare you too much. Remember that these are tail risks. By definition, they're unlikely to happen. But if they do occur, it could even be an opportunity because it pushes down the price of stocks and you can bag some bargains. Now, also don't forget our offer. We'd love to have you as part of the community and you do get access to lots of goodies. And as always, thank you for listening.